Economic stabilization, monetary versus fiscal policy. Monetary policy refers to actions taken by the central bank to control the money supply, interest rates, and influence economic activity. Fiscal policy, on the other hand, involves government decisions regarding taxation and government spending. Both policies can be used to stabilize the economy during periods of economic instability, such as recessions. Monetary policy focuses on managing interest rates and money supply, while fiscal policy involves adjusting government spending and taxation. The effectiveness of each policy tool depends on various factors, including the state of the economy and the specific circumstances. Handling recession, higher spending versus tax cuts. During a recession, policymakers may use expansionary fiscal policy by increasing government spending or implementing tax cuts to stimulate economic activity. Higher government spending injects money into the economy, creating demand and potentially increasing employment. Tax cuts aim to increase disposable income, encouraging individuals and businesses to spend more. The choice between these options depends on the specific context and the effectiveness of each measure in stimulating economic growth. Monetary policy, rule versus discretion-based. Monetary policy can be conducted through rule-based or discretion-based approaches. Rule-based policies involve following predetermined guidelines, such as targeting inflation rates or money supply growth. This approach provides transparency and predictability to market participants. Discretion-based policies, on the other hand, grant central banks flexibility in adjusting interest rates and money supply based on current economic conditions. The debate between rule-based and discretion-based monetary policy revolves around the trade-off between the need for stability and the need for flexibility in responding to changing economic circumstances. Central bank goal, zero versus non-zero inflation. Central banks typically aim to maintain price stability, but there is a debate regarding the optimal level of inflation. Some argue for a goal of zero inflation, believing that stable prices promote economic efficiency and minimize distortions. Others argue in favor of a low, positive inflation target, typically around 2%, as it provides a buffer against deflationary pressures and allows for more flexible monetary policy. The choice depends on the central bank's assessment of the costs and benefits associated with different inflation targets. Government budget, balanced versus unbalanced. Government budgets can be balanced, meaning revenues match expenditures, or unbalanced, where deficits or surpluses occur. A balanced budget implies that the government is not relying on borrowing to finance its expenses, which can be seen as fiscally responsible. However, during times of economic downturns or other exceptional circumstances, policymakers may opt for deficit spending to stimulate economic growth or address critical needs. The decision to pursue a balanced or unbalanced budget depends on the economic conditions and policy objectives. Tax laws for savings, reformed versus not reformed. The tax system can influence individual savings behavior. Reformed tax laws may introduce changes to tax rates, deductions, or incentives aimed at encouraging or discouraging savings. For example, tax reforms may offer tax deductions for retirement savings or tax-free savings accounts. The specific impact of tax reforms on savings depends on the design of the reforms and individuals' responses to the changes. Reforms may aim to promote savings as a means to support long-term investment and economic growth.